This is a download from BFM 89.9, the business station.
Good morning, Dodge. So U.S. stocks closed at record highs. This was following, of course, October, which is known as a historically tumultuous month. But what could potentially derail it aside from interest rate fears? Will oil prices be a factor?
Good morning, Nadia. Yes, oil prices will definitely be a factor, particularly for retail sales and the impact on consumer sentiment and market optimism. There are obviously all the world geopolitical risks that will continue. If the perception is that the current issue in the news, whatever it is, can be resolved without a military war, then any negative reaction to the news will be treated as a buying opportunity. What we're really watching with particular interest is the internals of the market. All bear markets start after that last high of the Dow Jones and the S&P 500. We haven't seen the final highs in either average, so it's premature to turn bearish. But it will be the market's reaction to the news, not the news itself, that will determine whether future pullbacks are more serious. And it will be the internal condition of the stock market, not the external, that will reveal those warning signs. So more than the actual news that is coming out, Nadia, we're really watching the market's reaction.
Eurozone's deflation, edged up. Inflation edged up, but is this any kind of positive sign? Because they're trying to stave off, deflation.
Yes, the inflation was just 0.4% in October. It was up slightly from September. But the trend itself remains weak, with several European nations in outright deflation. Overall, the Eurozone economy is still sputtering, and the ECB has taken only baby steps in contrast to the famous pledging of Draghi will do whatever it takes. That's really not been enough, and it's creating a potential loss in faith in the promise. Relative to the geofinancial picture, the ECB is moving very sluggishly in contrast to the U.S. Federal Reserve and Japan's Bank of Japan, acting very proactively and looking ahead. I'm afraid the Eurozone's most important long-term challenges are still in the future.
What sectors have done best so far this year, in your opinion, as 2014 draws to a close, and what's actually surprised you?
I've been surprised by the continuing sector rotation that we've been seeing. Part of the story has been driven by the fact that our markets have been based on low interest rates rather than on economics and company fundamentals. But what we've seen over most of the year, biotechnology and healthcare have been good. In the retail arena, we've seen apparel, automotive, home improvement, and food chains. Food chains have been acting very well. We're now seeing real estate investment trusts and utilities coming back for the more conservative portfolios. Particularly in the REITs, we see a fairly broad interest in REITs, in diversified office, residential, retail, and specialized. So that's one of the sectors I think will continue to have strength going into the new year. And of course, technology has been important. It's gone through some in and outs, and it's not across the board, but it is an important sector to watch. And the other one that we're watching is financials, especially banks and investment banks. It's important to watch them as they adopt different strategies to respond to the low interest rate environment.
You were mentioning the financial sector, actually. It's interesting because we have seen news of people like Deutsche Bank. They've taken some bit of a hit because of new regulations. So is it going to be a new dawn for the financial sector with new regulations, fines and everything? They're trying to find a new act, so to speak.
Yes, exactly. And the investment banks are going to have a hard time to respond to the concern to trading, to just downright trading, not only their own capital but their clients' capital. So it is a new world, Nadia, and investment banks, you'll recall, moved, like Goldman Sachs, moved into the commercial banking center by regulatory dictate. They're now going to be faced with opportunities outside that, and what are they going to do? It is a very different environment now, and that's really why we're watching the banks, because it will tell us what the future of financials are going to be and how the low interest rate environment transition is going to occur.
In an interesting twist, Japan's central bank boosted its asset buying program as the Fed actually ends theirs. It was a surprise to those in the market, but you think this is a sign that Prime Minister Shinzo Abe's strategy needs a boost? And more importantly for that country, do you think this will delay the second tax hike that he has on the cards?
Well, Friday was pretty incredible. The BOJ's move was also coupled with the confirmation that the National Pension Fund is making an aggressive move towards global equities. I mean, this is very unexpected. They're increasing domestic stocks to 25% of their portfolios from the current 12%. Domestic bonds will decrease to 30% from 60% now. Foreign stocks, it's not just Japan, but they're looking global. Foreign stocks will increase to 25% from 12%, and foreign bonds will increase to 15% from 11%. This is really quite an important move. Abenomics' goal of 2% inflation in 2 years has been acknowledged to be quite ambitious. In fact, it's been accepted basically as a statement of intent more than the real objective. So getting close to that 2-year date, Abenomics is facing and is going to have to deal with the legacy of promise that may not be kept. But overall, it is positive that the Bank of Japan, like our Federal Reserve, is being quite proactive and looking ahead. And the BOJ acted at a time when it will have a significant impact. And the BOJ's moves may very well help Japan's economy move in the right direction because inflation is partially routed in expectations of rising prices. In any case, the pending decision of that second tax rate hike will be very tricky, and Mr. Abe will want to ride this rally for as long as he can.
China's factory growth fell to a 5-month low. Is this a blip or is it basically the new normal?
To be expected given the world's geoeconomy and to be watched for its impact on lowering market interest rates. At the same time of the news, the HSBC Market Flash Manufacturing Purchasing Managers Index edged up to 50.4 from 50.2 in September. Although the improvement in the PMI is reassuring, the drivers of the growth continue to come from external sectors, not domestic. Domestic activity remains quite soft. With domestic demand remaining soft and disinflationary risks on the rise, there will be pressure for two cuts of 25 basis points in their market interest rates, probably before the end of the first quarter of 2015.
That was Dodger Dolan, Chairman and Chief Investment Officer of Land Infused Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.